Hi, this is Linda Hitt. We're going to look at the way assets are recorded and shown on the balance sheet at the end of an accounting period. The main rule is historical costs, and we'll look at the exceptions for a few different types of assets. Historical costs has been around for a long time. With U.S. rules, they stick to it because it's a very concrete thing. We can prove it with numbers that we've shown that how we paid for it. So it's objective and it's not subject to manipulation. The trouble with it is it's not particularly useful, it's not up to date, and land that you bought 20 years ago is still shown at the price paid, so it lacks relevance. However, it is used for most assets. We may see some changes because of international influence that doesn't use it as much, but right now we use it for our assets, and the exceptions that we don't use historical costs for include inventory and marketable securities. Inventory uses lower of cost or market, which is basically historical costs compared to replacement cost. If prices are constantly going up every time you buy your inventory, so your wholesale price is more than it was before, then you really stick to historical cost. So we're only dealing with this exception if the wholesale price actually drops. If the wholesale price drops, then our thinking is the retail price to the customer is likely to drop. So we kind of recognize losses and write-downs right away. So we wind up with a conservative approach because the asset inventory will be shown at the lower of two values, which in this case is replacement cost if it goes down, and the income statement will show a conservative profit because we'll recognize the write-down as an expense or loss. So in accounting, we're often quick to recognize expenses and losses and slower to recognize gains and revenues until they're actually finalized. And we will see a special adjusting entry in the problem that we do in a minute. The other exception is market value or fair market value, and there's limited applications of this. One of them is marketable securities, which is basically investments in stocks and bonds where you have traded prices, quoted prices, where it's traded on a regular basis over one of the exchanges. The valuation is up to date, so it's useful, it's relevant. International rules allow more assets valued in this way, but for our purposes, we look at two different types of companies. Those that buy and sell securities on a regular basis are called trading securities, and these companies include banks, stock brokerage, insurance companies, where you hold inventory in securities for a short period of time, a couple months, and you buy new ones and you sell them. So there's a slightly different way in our accounting for this compared to the other companies that are not banks, brokerage firms, and insurance companies, which we call available for sale or available for sale securities. So we'll take a look at that in a little bit. And we also will take a look at the special adjusting entry that goes with writing up or writing down our assets. The impact will be, of course, affect assets, and it'll also affect stockholders' equity. We'll see that depending on whether it's a trading security or available for sale security, it'll either be retained earnings or a new category under the stockholders' equity, which we'll see in our text as unrealized gain or losses. Okay, so now let's go ahead and move to our example, our problem, and a very basic problem. We're going to start out with land. Land is certainly valued with historical costs, so in our basic rule, we're going to buy land, pay $10,000, tiny little piece of land. I just like small numbers, they're easier to work with. And then what's the impact on the statements? Well, buying an asset like land certainly increases assets and also reduces assets. So we have an asset exchange and no other impact on the balance sheet, no effect on the income statement until we sell it at a gain or loss. And we know that our cash, of course, is going to go down. So we have investing as the section and an outflow of cash of $10,000. Next, we're going to look at the exceptions. So if we don't use historical costs, what are we going to do? Well, if it's inventory, we're purchasing the inventory. Eventually, we'll value it at the lower of cost or market. The purchasing of inventory, though, doesn't look very different than purchasing land. It's still an asset exchange where we have one asset going up and one asset coming down. And for cash flow purposes, no impact on profits. For cash flow, we know it's an outflow, and this would be operating, because this is what we do for our basic company, is buying and selling inventory. And then the other exception is short-term or long-term investments in stocks and bonds with quoted prices. I'm just going to put MS for securities, keep it short, and we pay cash. So again, not much different. It's still going to be an asset exchange, and no impact as usual on, whoops, did something they didn't like. No impact on the income statement and the cash flow. Short-term or long-term investments, investment makes sense, and it's an outflow of cash. Okay, and then we'll go back. Okay, so basically buying it's pretty much the same stuff. And then at the end of the year, we determine that the valuation of the assets are going to drop by $9,000, so that if we bought them at the end of the year, we would have only paid $9,000. With historical cost, we ignore such things. We have no entry for a drop in price, and there's no impact on the statements, and that's by definition what historical cost means. It sticks with the price paid. Lower of cost or market, we do see a drop in the valuation. You write the inventory down if there's a drop in replacement costs. So it went from $10,000 to $9,000, which is a $1,000 decrease. So I do have a special adjusting entry. I'm going to call it LCM expense. You could also write a loss for it for $1,000, and then the inventory itself is written down for $1,000. And so what does this do to our financial statements? We're taking the expense right away as soon as we know that there's a drop in our value. So inventory, the asset goes down, and if you remember with lower of expenses, all expenses cause retained earnings to go down when we close the books, and therefore stockholders' equity also decreases. Profits are less when you have an expense, and there's no cash. So that does have an impact that we can recognize. And then if we look at the third category, our marketable securities, it also adjusts for $1,000. So we're going to recognize what we call an unrealized loss. This is a paper loss. It's worth less, but we haven't sold it yet, so it hasn't really come to realization, which is simply means sale, and where you collect cash. But it has similar effect in some ways, not exactly, I should say, to the inventory approach. Here we need to know what type of securities are we looking at, what type of company. So let's look at trading securities first, which go with a company that buys and sells securities as part of what they do, and they buy and sell it frequently. So marketable securities, the asset goes down, and your unrealized loss is something new that we haven't dealt with before. And this one's going to, trading securities, actually, the impact of the loss is going to be treated like an expense. So it's actually going to cause retained earnings to go down. And I'm going to put retained earnings just to remind us of that. And I knew I would do that. We put retained earnings first and then minus. So retained earnings is actually going down. And because of this, when you have it on your statements, it does impact your income statement. It does lower your profits. And then there's no impact. It's a special adjusting entry. There's no impact on cash. So that's trading securities. And then what if we did the available for sale securities? Interestingly enough, it's the same journal entry, same titles, but it's treated differently with available for sale. Now I don't think we've ever seen that before, where a title can be the same but mean something different. But here's one of those exceptions. So once again, we see the asset value going down. This time, though, we have a different situation under stockholders' equity. The unrealized loss will not affect the income statement. So we're actually not going to put anything here, and therefore it's not affecting the retained earnings statement. But we actually have a new category. Remember, accounting is an art, and they can make up anything they want. And this is what they did. They created a section which we're going to call unrealized loss, but it's actually a long title which they call Other Accumulated Comprehensive Income, a complete mouthful. For our purposes, though, we're simply going to have common stock, retained earnings, and then unrealized items. So that's how they cope with paper gain or loss for a company that isn't going to sell the securities anytime soon. And the accounting profession just wasn't willing to put it on the income statement and affect the income or loss. Okay, so you can see that's a little more complicated, but they're okay with using it fair market value for securities that are traded and have a price because it's not subjective. We have a quoted price and it's out there. Now, what would happen in year 2 if we immediately turn around and sold the asset? With historical costs, we never change the value of the asset. So what we have is cash coming in at 9. I'll skip a space. Land going out at 10, the price paid for it. And then, of course, you can see that we need a debit of $1,000. So this time we call this a realized loss. This is not a paper loss. We don't necessarily write out realized, but when you see the word loss, you assume it's a realized loss in which you actually had a sale and you have fewer assets coming in than you have assets going out. The impact of making a sale with a loss: cash is an asset, so assets are going up by 9. Land is an asset, assets are going down by 10. So the net effect is that your assets are going to be decreased. And I'll go ahead and show you the amount, by $1,000. Losses are the same thing as expenses. When we do closing entries, retained earnings goes down. So we also see retained earnings under stockholders' equity decreased. On the income statement, we see a decrease in our profits because of expenses. And then cash, of course, always does its own thing. Under investing, we would see an increase in cash. So even though we have a lot of minuses, the cash flow statement still we recognize an improvement to cash. And that may not look like an I there, but it is. It's investing, an inflow of $9,000. Okay, then if we look over to inventory, we wrote the inventory down, so it's actually on the books at $9,000. So if we turn around and sell the asset for $9,000, we would actually have cash and sales. Normally we hopefully wouldn't sell it for 9, but I'm going to go ahead and just do this anyway. Cash and sales for 9, and we'd have cost of goods sold, expense, and inventory for $9,000. Usually we'd sell it for hopefully a higher retail price, but just to keep the example the same across the categories, what we'd see with these 4 account titles is cash is an asset, so assets are going up by 9, but inventory is also an asset, and assets are going down by 9. So that kind of offsets, and so we have basically an asset exchange. Normally you'd have your gross profit increasing assets, and then your stockholders' equity is not impacted because you've got an expense and a revenue. So here's the revenue for $9,000, expense for $9,000. So it's, I guess, a stockholders' equity exchange, but we won't have to put that. We don't usually show that. Well, let's go ahead and show it. What the heck? Okay. And then on your income statement, it's a plus, an increase for revenues, a decrease for expenses. And then your cash flow, there is something. Like I say, cash flow has always got to do a little different thing. Under operating, we have $9,000 cash coming in from the sale. Okay, so because the inventory was already written down, we're not recognizing a profit, but we're also not recognizing a loss. If the inventory had not been written down, we would actually have a $1,000 loss, realized loss in year 2. So you can see what we did is we moved the loss as early as possible and moved it up to the first year rather than the second. And then your 2 categories. We'll look at trading securities first. We wrote down the trading securities, so now if we make the sale, then what we should see is that we get cash for 9, Marketable securities has been written down for 9. Okay, so we have that. We don't really have to recognize a gain or loss. Though we do have a situation now, because it was a paper loss, for trading securities, I guess we could just stop with that. We're kind of going from an unrealized to a realized loss. But it's already impacted the statements, so I'll put trading securities, and that's probably the main impact. And so we can see, because we've written again the securities down, that we have cash going up, trading securities going down. Take that out. Oh, I know what I did. Do a plus, enter, minus, enter. There we go. No gain or loss. Again, the impact was on the statements in the first year. For cash, we do see investing and an inflow of $9,000. Okay. So that's trading securities. And if we do the available for sale, I guess again we're going to see the entry looking similar. So I'm going to just cut and paste this down. Whoops. Oh, I know what I'm doing. Getting it on the wrong spot. So available for sale. So we have, again, the plus and the minus. An exchange. I put it in the wrong. If I put it in the same space, that's the problem. Minus. And we can do the same thing under stockholders' equity, except under stockholders' equity, actually we don't have, putting this up, we have an asset exchange. And the cash flow, the cash inflow is still investing, so I'll put the 9,000. But there is a difference with available for sale, because right now we have unrealized loss, which is sitting there under stockholders' equity. So if we make the sale, we really need to get rid of the unrealized loss. So I'm going to put an actual loss of 1,000, and then cancel out the unrealized loss, which is under stockholders' equity, just sits there until you sell the security, and deal with that. So that's going to cause assets to decrease by 1,000, stockholders' equity to decrease by 1,000. This one's kind of crazy. I guess the loss causes retained earnings to go down, and as usual I have to write this first and then the minus. And then the other category, your unrealized loss, we have to cancel that out. So I guess that would actually be, it's increasing that section. So it does require, I guess, an extra step. Okay, so that takes us through a decrease in price. So what's going to happen if there's an increase to price? And we won't bother purchasing the asset again because we've already done that. And I'll come down a little bit because I've used up more space than I thought. At year end, if the asset is now worth $13,000, with the original example with land, as you can see at the top, with historical costs, no entry. You just leave it the way it is. No impact on the statements. With lower of cost or market, if the price goes up, replacement cost, no entry. But with your securities, let me see if I can take that out, you actually do need to make a journal entry for an increase. So we can see the increase is the difference between $13,000 and $10,000. So $3,000 increase. So if you're trading securities, we're going to have marketable securities increase and unrealized gain this time. So that's for $3,000 and $3,000. And if this is available, trading rather, do that first. We buy and sell it on a regular basis, then it's going to impact assets going up and your stockholders' equity increasing, and that's going to be under that new category, unrealized. I'll just put unrealized gain, and it's a plus. So that's the third category. We have common stock, retained earnings, and unrealized items. No impact on, this one actually does impact net income. So income would be going up, and cash flow is the no impact. Okay, then if we had the available for sale securities, then once again we'd have the same journal entry as we have with the trading securities, but its impact is a little bit different. The assets are the same, so we'll see an increase in assets. Unrealized gain for available for sale will be in, I did this, okay, I'm sorry. I did this, a trading security, I'm sorry, is the increase in the retained earnings. So let me put that up there. Too many different things going on. Retained earnings goes up because of the trading securities and the income. But because unrealized gain on available for sale is in the stockholders' equity category, there's no impact on net income, and it goes into unrealized items. If I can type it, unrealized gain would be recognized. And of course there's no impact on net income or cash. Okay, so it's either retained earnings for trading securities, plus or minus, or it's the unrealized gain, which is under stockholders' equity but is not retained earnings for available for sale. Okay, and then finally, let's say we sell the assets for $13,000. If you're selling the land for $13,000, land is still on the books at 10 historical cost, so we know that it's gone up in value by 3, and this time since we realized it, we've actually got cash in hand, we're going to recognize it. So here's the recognized gain of $3,000, and this should mean that we have more assets by 3, cash higher than land. Gain is a revenue, and it closes into retained earnings, so our retained earnings goes up. Our net income is increased, usually under other revenue and expense, and the cash is $13,000. So that's going to be investing. I'll just put I and $13,000. Okay, so that's kind of what we expect. With lower of cost or market, when we sell the asset, if you remember, we'll have 2 entries. We'll have the entry for the customer, and then we'll have to recognize our cost. So here we're saying we sold it to the customer for $13,000. I'm just going to use that as our retail price. The cost we paid for it originally was $10,000. So I'll pick up the $10,000. And the impact then is the difference between the 13 and the 10, of course, is $3,000. So we have more resources by 3 because we wind up with cash being higher than the inventory we're giving up. Retained earnings goes up because you're going to close sales revenue and cost of goods sold into retained earnings, and the difference is 3. Your profit on your income statement is going to be $3,000, the difference. And then, of course, cash would be operating and $13,000. Okay. So one thing you see here, because we did not write up the inventory is at historical cost, and so it's really comparing historical cost to the retail. And then available for sale, when you make the sale, if you're trading securities, then we have cash coming in. We have marketable securities going out. So let's see what their values are. Cash is 13. We wrote up the marketable securities, so I guess I can move that up one. We wrote it up to 13,000 in last year, so we recognized it early, which is fine. And so what we basically see is an asset exchange. No impact on profits. The impact on the profit was last year with the trading securities. And no impact on the cash. Actually, we would impact. The cash would be investing, and it would be a $13,000 increase. Okay, and then if we dealt with the available for sale security, the only difference is that we need to recognize a realized gain. So we have that account called unrealized gains just sitting there under stockholders' equity. So what we really have to do is close that out, get rid of the realized gain, take it off of stockholders' equity, and then pick up a normal gain, regular gain. So this is only true for, and I can put this down here, for available for sale. I'll just abbreviate it. So that's 3,000 and 3,000. So what we're really doing here is simply taking it out of the unrealized category. I'll just put unrealized. Take it out of there, and the realized gain will have an impact of going into your income statement and adding to it, and then your retained earnings will go up, so it'll offset. For cash flow, again, we know we've already dealt with that, so it's investing. So it's interesting, if you have unrealized gain or loss for available for sale securities, that's under stockholders' equity, and it does not close out, so that when you make the sale of securities, you actually have to close out the unrealized account then. So this concludes our comparison of historical cost, lower of cost or market, and fair market value.